Welcome! In this explainer, we're getting right back to basics and tackling the very foundation of the new Income Tax Act 2025. We're talking about the definitions in Section 2. You know, if you get these wrong, pretty much everything that follows can start to fall apart. So let's dive in.
Let's kick things off with a situation that I'm sure sounds familiar. Imagine your client sells a piece of farmland right on the edge of a growing city, and they make a really nice profit. Their first question to you is almost always going to be the same. Hey, it's agricultural land, so that's tax-free, right? Sounds simple enough. But as we all know, in tax law, the simplest questions can be the trickiest.
And the answer to that very common question? Well, it all hangs on how the new 2025 Act defines two very specific terms: agricultural income and capital asset. This is the perfect example of why getting the definitions right isn't just step one, it's the most important step in any tax analysis.
I want you to think of the Income Tax Act as a whole new language. Seriously. And just like with any new language, what's the first thing you need? A dictionary, right? You need to know what the words actually mean. Well, in the world of the Act, Section 2, that is your official dictionary.
Every single term, from assessee all the way to capital asset, has a precise legal meaning that's defined right there in Section 2. So before you even think about applying any other section, you have to come back here. You have to make sure you're speaking the same language as the law. This is your foundational tool. So, let's start with the most fundamental question of all. Who does this act even apply to? The law has a specific term for this, and that term is the assessee. Understanding its scope is really the first piece of the puzzle.
Okay, so Section 2, subsection 11, starts out pretty simply. It says, an assessee is a person who has to pay any tax or any other sum of money. But, you know, it's tax law, so of course, the story doesn't end there. There's a lot more packed into this definition.
In fact, the definition really creates four different kinds of assessees. First, the obvious one, any person who's liable to pay tax. Simple. Second, and this is important, it includes anyone involved in a tax proceeding, even if you're just claiming a refund. Third, you've got what's called a deemed assessee. Think of a legal representative handling taxes for someone else's estate. And finally, there's the assessee in default, like a company that fails to deduct TDS.
So why does this matter so much? Because this term, assessee, isn't just about who pays tax. It's much bigger. This broad definition is what establishes the entire jurisdiction of the income tax authorities. It defines the whole universe of people and companies that can be pulled into tax proceedings. It's huge.
All right, let's move on to one of the most debated and litigated areas in tax law: agricultural income. Everyone knows it's supposed to be exempt, right? But the real question is, what exactly is agricultural income, according to the Act?
Now, Section 2, subsection 5 defines it in a couple of ways. It's either rent or revenue you get from land that's being farmed, or it's the income you make directly from farming operations, selling your crops. That part is usually pretty clear.
And this brings us right back to our opening question. What about the profit you make from selling the land itself? Is that also considered agricultural income? The Act makes a really important distinction here. The exemption for agricultural income doesn't just automatically cover the profit you make when you sell the land. That depends on our next definition.
This is where the law gets incredibly specific. For a sale to be tax-exempt, the land can't be too close to a city or town. The Act sets out these very clear distance and population rules, measured aerially. For instance, look at that last row. If your land is within 8 kilometers of a city with more than 1 million people, it's just automatically not considered agricultural land for the purpose of a sale, period.
And you see how that works? It leads us directly to our next crucial definition, capital asset. Because if a piece of land is not considered agricultural land under those specific rules we just looked at, it automatically becomes something else. It becomes a capital asset.
Now, the definition of a capital asset in Section 2, subsection 22 is incredibly broad. It literally starts with property of any kind. I mean, that's a classic catch-all phrase, isn't it? The starting assumption of the law is that basically everything you own is a capital asset, whether you use it for business or for personal reasons. But the real action in this definition is in the exclusions. The Act specifically carves out certain things, like your business inventory, most of your personal belongings, and here it is again, agricultural land. But for that land to be excluded, it has to be located outside those specific distance and population limits we just covered. If it falls inside those limits, it stays a capital asset by default, and guess what? The sale attracts capital gains tax.
Okay, that's a lot of theory. Let's make this real.
let's connect these definitions to a practical scenario and see exactly how they all fit together.
So, let's circle back to our client. We'll call him Mr. Sharma. He has genuinely used his land for farming for years and years, and now he's sold it for a very large profit. He's convinced it's all tax-free.
Now here are the critical facts you need. The land is located just 3 kilometers away from the edge of a municipality, and according to the latest census, that municipality has a population of 200,000 people. Let's apply the law.
Okay, let's walk through this step by step. First, is Mr. Sharma an assessee? Yes, absolutely, the act applies to him. Second, is his land considered agricultural for the purposes of the sale? Well, the city's population is over 100,000. That means the disqualification zone is 6 kilometers. His land, at 3 kilometers away, falls squarely inside that zone. So the outcome is crystal clear. This is not exempt agricultural land, which means it remains a capital asset, and the profit is a taxable capital gain.
So, as professionals, how do we make sure we advise clients like Mr. Sharma correctly and stay compliant? It really comes down to a few key action points.
First, and I can't say this enough, always start with Section 2. Second, document your reasoning for how you classify an asset. Don't just make an assumption. Third, for land deals, you absolutely must verify the exact municipal limits and use the population data from the last published census. This is not optional. And finally, you have to educate your clients on that crucial difference between income from farming, which is exempt, and the profit from the sale of the land, which might not be.
All right, let's do a quick summary. Remember, Section 2 is your dictionary. Master it. The term assessee is way broader than just someone who pays tax. The tax treatment of farmland sales has everything to do with geography and demography, not just how the land is used. And that means not all land that grows crops is exempt from capital gains tax when you sell it.
At the end of the day, in tax law, your foundation is everything. If you can master these definitions, you've mastered the first and most important step to advising your clients with real confidence. So it leaves me with one question for you. How many of your clients' assets might have quietly changed categories under this new act?
Thank you so much for watching. If you found this explainer useful, please do like, subscribe, and share it with your colleagues. And just a quick reminder, this video is for educational purposes only and does not constitute professional advice. Tax laws can and do change, so please consult your professional advisor before taking any action.